Rajiv Batra, Head of ASEAN Region, APAC, ex-Japan, China Equity Strategy of JPMorgan joins us. Now, Rajiv, that's a very long designation when every time I introduce you. Head of India, ASEAN, APAC, ex-China, Japan Equity Strategy, right? Visiting card mein aa jata hai sara.
No, so I'm wearing 4 hats right now. I'm heading India, ASEAN, Asia, and now even emerging markets, which is missing from the designation.
Oh, great. I'll add it up next time when I introduce you.
Thank you.
How you been, my friend? All well?
All well, surviving the volatility in the Asia and emerging markets.
How long do you think we will have to bear this volatility? I mean, if I put on paper, India is the best story in the town. Valuations were expensive, they are no longer expensive. But FIs are selling this market down as if there is a problem with the economy or a problem with the market.
I'll just say one factor, and that is growth. Because investor comes to India not looking at valuation, not looking at positioning, they just invest on one variable, and that is growth. So if you look post-COVID, for 4 years in a row, compounded annual earning growth in India was in the range of 20-25%. Over the last 12 months, particularly last 3 quarters, growth came down to 6% in terms of earnings. In that scenario, FIs are questioning 19 PE, which is post-decline, 6% earning growth. Rajiv, is it good enough? Or should we look at other market which trades at 10 PE, but still give us 10 to 11% earning growth?
I just come back to this whole point that why this realization has sunk in now. I mean, the intensity of selling has only increased from last 1 quarter. The fact that India was expensive, the fact that other markets were trading lower, the fact that on a longer term basis, Indian currency declines 2 to 3%, the fact that in India capital gains are there, which other markets do not have. All these are yesterday's trends. So why are FIs reacting to yesterday's trends and yesterday's story? I always thought markets are forward looking.
No, you picked up quite well. It all started with the event that has happened since early November, which we saw the change in the leadership on the US side. And post that, we have seen $40 billion outflows in emerging market equities. Remember, this number is in line with what you saw in terms of outflow from EM during the COVID outbreak. Now, as a thumb rule, people will sell what they own. In emerging market for the past 4 years, the darling markets were India, Brazil, Mexico, Taiwan, Indonesia. Now, when the sell down is happening, these are the markets which are suffering. And when the suffering happens over there, people will try to choose the negative as a reason rather than looking for a forward-looking reason. So even if the strategy has been in the past, fundamental market, buy in a dip, but people tend to go with the momentum. And that's what is largely impacting India right now.
Okay. So Rajiv, what's next now? How do you see the events unfolding? When do you think FIs will genuinely come back? And when do you think the word value for Indian markets will also come back? Because right now FIs are missing, the word value is missing, the word momentum is missing. And for markets to go up, momentum has to come back, FIs have to come back, and value has to come back.
So interestingly, we have started getting incoming on India from long-only investors, and most of them are the sticky investor side, like pensions and insurances of the world. Kind of the value has emerged, which broad index is still not showing you. It's showing you at 19p, but at a single stocks level, sector level, it has becoming quite attractive enough. That's where foreign investors have started questioning. Maybe we are a few weeks or a month away where markets will find its trough and even foreign investors will start looking market back again. What could be the drivers for that? One, definitely we need to come out of the situation of this liquidity squeeze or a deficit overall, which I can say is double impact happening because of a dollar outflow that is happening through the country, and top of it, ongoing domestic side also tax payment system is period is coming during the month of March. If the liquidity issues get solved first, that removes some amount of a headwind, then followed by growth indicator. Remember, third quarter earnings are largely over. People will not wait for fourth quarter earnings. So they will track high frequency data. So if the GST numbers are improving, cement consumption or spending data is also improving. Like this, if high frequency data points start getting better, the trust will come back. Although people do agree that looking at the budget and looking at the monetary policy, there has been a pivot towards the growth. Concerns on inflation has come down, and now there's an effort happening from both the side, like the consumption-led stimulus, which we have seen, plus monetary policy easing in form of OMO operations, plus policy rate cut, are all growth supportive. But can growth come within few days, month and week? No, you have to wait for a quarter or couple of months. So that's what foreign investors want to see. And especially in an environment where you are getting very high yields in the money market fund in the US, and the exceptionalism is still trying to tell people that stick or remain with the US equity, the big growth story.
All right. Hi, Rajiv. This is Shrishti also joining in. But given the budget announcement, there has been a big boost towards the consumption side. Give us a sense that where do you see this tax exemption money flowing into the purchases being made, and which are the themes do you believe that could do well in the next 5 to 7 years?
So if you look at consumption stimulus, people are expecting it is a magic wand and it will start impacting you from the next day of the budget. In reality, we know from which fiscal year it will take. That is from the next fiscal year, April onward. So the first set of a tax deducted salary will come into people's account on 29th or 30th of April. As you see lower tax being deducted or money amount is little bit higher, that money will start coming into the system either in form of spending or going into the bank account in form of a saving. On either which ways, it will be supportive for household consumption and propensity to spend. It can directly go for a consumption in urban low ticket discretionary item, which benefits your QSR, which benefits your food and beverages, some HPCs guys overall. But at the same point of time, even if it goes for a saving, that will help repairing the strained balance sheet of urban household overall. And that will also improve their ability to service their debt and borrow in future if they want to do that. So either which ways, both the side, it will be beneficiary for consumption plus saving, according to me.
So Rajiv, I'll construct a scenario for you, which is that 6 to 9 months from now, a lot of clarity would have emerged. Where the economy is headed, what is happening to the government capex, how exactly the world is adjusting to the new tariff war, which way the US economy is moving post the change of administration. So if 9 months from now, a lot of uneasy answers would be answered, how do you see markets moving? Because 9 mahine ke aage to markets will be able to see everything.
No, that's what even I'm looking at it, and I have not cut down on my overweight position on India, because even today, if somebody asks me that, Rajiv, from a 12-month outlook or till end of this year outlook, one market which I should buy and keep, my answer is still India. Because the big narrative change which is happening in India and people are not gathering it, we were in a massive fiscal and monetary policy tightening mode. 9% fiscal deficit during COVID is almost now coming down to 4.4% level. Policy rate went from 4%, 4.5% to 6.5% and stayed there till almost till January. So that massive squeeze has happened on growth, and last 3 quarters have showed you that. Now you have to change the tone 180 degree against that, like policy on the easing side, fiscal is giving you room. So think about it, how world, particularly domestic India, will look like in 2 to 3 quarters time. Now, people are not recognizing it, what momentum change can happen on growth and earnings, and they are just going with the price momentum action. And the reason behind it, that India, based on our QMI indicator, was in the late cycle stages. And during the late cycle stages, before reaching to the inflection point or moving from late cycle to early cycle, price momentum gives up. And most investor reacts as per that, which is happening right now. But as you come out of this one, then you will start looking into the spaces like beta, you will start looking into spaces like earnings revision and stuff, and that will be the right measure for India. And you correctly mentioned that once people adjust to the new reality that global growth is either anemic or global growth is above par over there, people will start revisiting the story where the growth is still there, valuations are reasonable, and particularly where the positionings are. So if again you look at emerging markets overall, before 2016, 8% was the ownership in emerging markets overall by the foreign investor. Today, that number is 4.9%. As I've said at the start, you sell what you own. If you are not owning EM much and positioning is lighter, then market will behave as per their domestic clients and the domestic indicators overall.
I have a very simple follow-up question, which is that the general consensus view, and since you represent an institutional, brokerage firm, is tilted towards large cap stocks. That's where valuations are comforting. That's where liquidity is strong. That's where, that's where I think the comfort from everyone is quite visible. But my point is, if FIs are selling, they will sell what they own, and FIs they own banks and large cap stocks in India. So why should one buy large cap stocks when FIs are selling? And why these large cap stocks are not falling? No, they are not falling also, Rajiv. I mean, itna na FI bech raha hai, large cap stocks are not falling. So what are FIs selling then?
No, it's a two-way ride which is happening right now. So when we look at a 4-year comparison of domestic institutional investors, where they build up the position and they cut down. In this exercise, we have seen that sectors like auto, energy, industrials, utilities were the sector over the 4-year period gained lot of allocations by the domestic institution side, and the funding source were consumer staples and financials. Now, when foreign investors are selling BFSI, and the last data point of January shows you that under NSDL, in this 9 billion sell-off, 2.8 billion came through the financial side. Who were the buyer? The buyers were your domestic investors who are not positioned in consumer and financial driven trade. That is what is supporting your banking sector overall. Now, foreign investors, like that for the 3 decades or 4 decades, were largely investing in India for the consumption story. So their top overweight always used to be IT services, consumers, and banks. With the ongoing budget, or this budget session which is on, or with budget that has got concluded, the pivot or tilt that has made on the consumption side, that will again get the belief of foreign investor back that India is again supporting the consumption story. Knowing that into account, once the dust settles, people will make a comeback again in the same old spaces like financials, IT, and your consumer. Large cap as a bucket, you will see, is more biased, or you can say more heavyweights on this particular 3 sector, whereas your mid and small caps were more like edged on your industrial, capex, or manufacturing related story. So based on the theme or narrative which is there ongoing in market, looking at the picture, so if consumption is making a comeback for next year, 2, or overall, that will be supportive for your large cap and primary, the 3 sectors.
All right, but Rajiv, that's heartening to note that you're not cutting down the overweight stance on Indian markets. But given the recent correction, tell us the sectors that you are having your overweight stance right now, and the sectors that you still believe that they are expensive, the growth outlook is not that great, and you maintain your underweight stance there.
So we upgraded post-budget consumer discretionary X passenger vehicle overall, and we, you can say, booked profit or neutralize our overweight on industrial sector. That made us overweight now on financials, consumer staples, consumer discretionary X passenger vehicle, healthcare, and real estate. How we are funding it this through? We are underweight on energy sector. We are underweight on material sector. We are underweight on passenger vehicle, or largely you can say auto. And we are neutral on energy, but with more, you can say, a kind of a negative deviations to the benchmark based on our portfolio allocation. So you can say marginally negative. The reason behind this, if the things are getting bit stable or selective on the capex side, your commodities will take a hit. And knowing the neighboring country, China, where they also are willing to grow this year more through consumption rather than fixed asset investment or a trade pattern, then definitely it is not a great news for the commodity space. So that makes us a bit bearish on the commodity side. On passenger vehicle, again, if the demand is coming back in urban areas overall, it is not going to be on the high-end basis or even on the mid-end. It will be on a low-ticket discretionary item. So that will be supportive at max on the two-wheeler side. So looking at the inventory picture overall and looking at the saturation which four-wheeler side or passenger vehicle is side seeing, we are, you can say, underweight on passenger vehicle or auto space.
Uh, Rajiv, what is the importance of this dollar? I mean, it is a very basic indicator, but the indicator which everybody uses as the ultimate benchmark. And the example I was just, giving to someone was that it is like saying that you look at the trailer of the movie and you can guess the entire movie. Everybody gets up in the morning and they say, "A dollar is up, markets will go down, FIs will sell." In the overall scheme of things, what is the real importance of it? Are we making a mole out of an indicator, a mountain of it out of an indicator?
No, it is an important indicator for the dollar investors, because end of the day, whatever money they are investing and they will be redeemed based on the dollar benchmark over there. So even if in local equity terms you make a phenomenal return, but same amount of money you are leaking in terms of a currency, so that generally discourage them to put money into the emerging market or a non-dollar asset class overall. Especially in this current environment, as I alluded earlier, that if you are getting 4.5%, 5% in risk-free asset class in US overall with the dollarized pattern, why you will move outside in lure of a higher return unless they offers you growth in future, but at the same point of time offering you a stability in currency too. So India did both the thing. India achieved a higher local currency return also based on the higher growth and maintained stable currency also. That's why India was in a vogue. But now suddenly where currency is not just purely reacting to dollar. Remember, currency is also reacting towards the trade weighted currencies of other part of the world, where your real effective exchange rate was 9% overvalued, and now it has been brought down to acceptable range of 0 to 3% of overvaluation only. That's where the stability is finally coming in. Let's hope this level remain for a quarter or so and growth makes a comeback, then people will relook at India. But for emerging markets or India per se, three indicators are very important in going in this environment. Number one, dollar. Number two, how tariff react. And last but not the least, I'll say growth differential, because people will compare India's earning growth or GDP growth versus US growth. So if growth differential is wider, yes, more money will come to us. But if it is getting narrower, it will stay at home.
With this, we let you go on that. Really appreciate you taking the time out and speaking with us this morning. Thank you so much.
Thank you.
But with